The story of Allbirds represents a fascinating case study in sustainable business growth and its inherent challenges. Founded in 2015 by Tim Brown, a former professional soccer player from New Zealand, and Joey Zwillinger, a biotech engineer, the company set out to revolutionize the footwear industry through environmentally responsible practices and natural materials. Their initial vision centered on creating simpler, low-impact shoes using natural materials, particularly merino wool, when demand for wool had declined in New Zealand. The company's initial success was remarkable. Their signature Wool Runner shoe, launched in 2016, quickly gained traction among urban professionals and tech workers, particularly in Silicon Valley. The combination of sustainable materials, minimalist design, and comfort resonated strongly with consumers willing to pay a premium for environmentally conscious products. This early success was bolstered by viral marketing and word of mouth growth, particularly in tech circles. Early momentum led to significant funding rounds, with the company raising over $200 million in venture capital. A series of successful funding rounds followed, including a Series C round in 2018 that valued the company at approximately $1.4 billion. By 2021, Allbirds had reached a pivotal moment with its IPO, where shares surged 90% on opening day. However, this marked the beginning of a challenging period that would test the company's fundamentals. The problems began to surface as Allbirds attempted to expand beyond its core footwear business. The company ventured into apparel, including dresses and puffer jackets, which proved to be costly missteps. By 2024, revenues had fallen approximately 25% year over year to $189.8 million, with net losses exceeding $93 million. This decline was particularly striking given the company's earlier growth trajectory and market enthusiasm. Several key factors contributed to this decline. First, the company overextended itself with aggressive retail expansion, opening stores that would later underperform. Second, inventory management became problematic, leading to significant write-downs and liquidation costs of approximately $13 million. Third, the attempt to diversify into apparel diluted the brand's focus and stretched resources thin, forcing the company to eventually scale back these initiatives. The competitive landscape also intensified during this period. While Allbirds had carved out a unique position in sustainable footwear, larger incumbents like Nike and Adidas began launching their own eco-friendly lines. Meanwhile, other sustainable footwear startups like Veja, Rothy's, and On Running emerged, fragmenting the market further. These competitors brought their own unique value propositions, from high performance to fashion-forward designs. In response to these challenges, Allbirds has undertaken significant strategic shifts. Under new CEO Joe Vernaccio, who replaced co-founder Swillinger in 2024, the company has refocused on its core footwear business. This includes closing 10 to 15 underperforming stores, scaling back peripheral product lines, and optimizing inventory management. The company has also shifted toward a more selective wholesale strategy, particularly in international markets, to reduce fixed costs. The company's innovation in materials science remains a bright spot. Partnerships with companies like Blue Maca and Cirque have led to breakthrough products like the Remix collection, which transforms manufacturing waste into premium sneakers. These initiatives demonstrate Allbirds' continued commitment to sustainability innovation while attempting to build a more sustainable business model. The company has also maintained its focus on transparency, publishing carbon footprint data for its products. Financial metrics tell a sobering story of this transition. While gross margins have shown some improvement, reaching 42.7% in 2024 compared to 41% in 2023, persistent operating losses highlight the challenges of achieving profitability. The company's stock performance has been particularly troubling, necessitating a 1-for-20 reverse split in 2024 to maintain NASDAQ compliance. Market capitalization has declined significantly from its initial public offering levels. Looking forward, Allbirds' success will depend on executing several critical strategies. These include developing more predictable revenue streams through potential subscription models, forming selective wholesale partnerships rather than expanding owned retail, and strengthening sustainability credentials through third-party verification. The company must also continue to innovate in materials while maintaining strict cost discipline. The Allbirds story offers valuable lessons for mission-driven companies. While a strong environmental mission can attract initial customer interest and investment, it cannot substitute for sound operational execution and financial discipline. The company's experience shows that careful pacing of expansion, maintaining focus on core competencies, and building a sustainable cost structure are crucial for long-term success. For the sustainable business sector broadly, Allbirds demonstrates both the opportunities and challenges of scaling an environmentally conscious brand. As consumer demand for sustainable products grows, companies must balance mission driven initiatives with practical business fundamentals. The sustainable footwear market, projected to reach $12.3 billion in 2024 with compound growth of 16.8% annually, offers significant opportunity but requires careful execution. The company's future will largely depend on its ability to maintain its sustainability leadership while achieving profitability. This includes successfully managing its retail footprint, optimizing inventory levels, and potentially exploring new revenue streams like repair services or circular economy initiatives. The appointment of new leadership and renewed focus on core products suggests a recognition of these challenges and a commitment to addressing them. The broader implications for mission driven companies are clear. While sustainability can be a powerful differentiator, it must be coupled with strong operational execution and financial discipline. Companies must carefully balance growth ambitions with practical limitations, maintain focus on core competencies, and build robust operational foundations to support their environmental missions.